Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So Wall Street is looking ahead to tomorrow's speech from Fed Chair Jerome Powell at the Jackson Hole Symposium. We heard earlier today from Austan Saunders. She is the chief investment strategist at Charles Schwab.
I'd be surprised if Powell was explicit. This is a pre-planned speech. It's about the framework that the Fed operates under, and I think his formal comments will largely be about that with any kind of signaling. That doesn't mean the attention is not going to be on that, but I do think it's the labor market that holds the key.
Austan Saunders there from Charles Schwab. In a moment or two, we'll have a little more on what we can expect from the Fed's Jackson Hole Symposium. We'll bring you part of our interview with Chicago Fed Bank President Austan Goolsbee. But we begin this morning in Hong Kong. Joining me now is Ian Samson. He is multi-asset portfolio manager at Fidelity International, and Ian joins us from our studios in Hong Kong. Thank you so much for making time to chat with me. I know that you manage a dynamic inflation fund. What a perfect topic. This is such an interesting situation that we're seeing across the globe right now. Different jurisdictions have different dynamics. We know what the story in Japan is. Inflation there has been well above target. Completely different story on the mainland in China. What is your position right now? Or put it in another way, how are you positioned right now?
So I think there's two things to focus on. One is the outlook for Federal Reserve policy over the next year. And it seems pretty clear for a variety of reasons that the balance of the committee will shift in favor of the doves, and we will see meaningfully looser monetary policy over the next year in the US. And I think that comes with looking through tariffs to some degree as if they were a tax hike. So that's lower interest rates in the US despite quite sticky inflation. Then I look at emerging markets to sort of see where are the opportunities. There's a lot of places where you've still got very high yields, whether it's in Latin America, whether it's in this part of the world in Asia, South Africa, where inflation is actually quite low, almost near target, and you're getting really, really high yields on the fixed income side, on the currency side. So you combine that with a looser Fed policy, and we're finding some really exciting opportunities within emerging markets.
So I'm glad you mentioned the Fed, but we just had recently the minutes from the last meeting, and I think many on the committee see the risk of upside risk to inflation as being greater than the overall weakness of the labor market right now. So if your inclination is to say, well, maybe the Fed is going to adopt a dovish stance, we're looking at easing going forward, is there a bit of danger here if inflation proves to be more stubborn or sticky than the market right now is prepared for?
I think in the short term, yes. So over the next few months, there'll be definitely a live debate, even though employment numbers are, in our view, going to continue to remain soft, whether it's 2 cuts they should do this year or 0 cuts. You see the dots where each Fed member lays out what they think is the appropriate policy path. They're very split over the next year, to the end of the year, whether there should be no cuts or 2 cuts. But again, I think as we go into next year, we will have had a period of slower growth in the US. We'll get a replacement for Chair Powell. We'll get a rotation in who actually votes on policy. And that's going to favor the doves who, as I say, they would, if they were in the ascendancy, give us 2 cuts this year. And they think that the appropriate rate for policy at the end of next year will be closer to 3%. So I think they're going to look through the slightly stickier inflation as if it was just the result of a tax hike, which it is, because it's most likely to come through tariffs.
What about the situation in Japan, where inflation, we know, has been well above target for quite some time, and the BOJ has been very, very careful about raising interest rates? Are we going to see a shift here, maybe as soon as the October meeting? Are they behind the curve? Maybe that's another way of phrasing the question.
Yes, careful is one way to put how slow they've been to react to higher inflation. So currently, the headline numbers in Japan are, I think, is 3% or so. A lot of that, frankly, is food inflation. It's rice inflation. But still, for Japan, when you strip that all out, you've got about 1.5% inflation, which for Japan is very high, almost at target. And now that you've got a reasonably acceptable equilibrium on US-Japan trades, I think that's a green light for the Bank of Japan to continue hiking interest rates. Because right now you've got a deeply negative real interest rate with inflation clearly well entrenched. And so the way that we play that from an investment perspective, there's a few ways. We don't like the short end of the Japanese yield curve, and we do really like Japanese bank equities because the more the Bank of Japan hikes, the more they benefit. It's great for their profits, and they're still at a very reasonable valuation.
It's amazing to think that there is at least one generation in Japan that has never known higher prices. And so this is a seismic shift. It's been going on for a while, clearly, emerging from a deflationary trap after 3 decades. And that brings me to China, because they've been struggling right now with the deflationary forces, particularly at the wholesale level. Demand, we know, has been very sluggish. The government, again, here is another situation where things have been very careful. Is there danger here, too, on the deflationary side at the wholesale level in China, and maybe to a lesser extent, the disinflationary side at the retail level in China?
Sure. I mean, it is interesting. About the only place in Asia with inflation is Japan. You know, it's not just China. China's potentially even exporting disinflation to the whole region, and that's a big theme within the funds. But thinking about China specifically, I believe the reason that we've got this very low inflation environment, partly it's demand, but the way that the Chinese government has managed its economy for well over the past decade is it always stimulates the supply side. And that leads to overcapacity, a lot of supply, very low profit margins, and whether it's solar panels or EVs, that supply side stimulus just creates disinflation and overcapacity. There has been, under the slightly strange name involution, a campaign. It's been about a couple of months now from Beijing, trying to get companies to stop this fierce competition and this oversupply. I think that's probably easier to say than to actually achieve. So we expect more of the same, really, in China. Subdued demand, weak pricing. And so when I think about investing in China, it's really finding the sectors where that dynamic of oversupply, government stimulus is less of a factor. And of course, for the story to really change, the government will have to move from supply side policy. It'll have to have an effective anti-involution policy shift and hopefully get demand going again. I wouldn't bet too heavily on that quite yet, but it's something that we're watching for.
As long as we're talking about the influence of trade, I mean, the South Korean economy is very vulnerable to trade policy, a big exporter. At the July meeting, the Bank of Korea seemed to indicate the door was open for a rate cut. The last reading, I believe, that we had on PPI in South Korea was pretty hot, I would think, 0.5% at an annual rate. Do you think the opportunity is now when South Korea needs to, let's say, move rates lower, even though consumer debt levels are high right now? Is it incumbent upon the BOK to deliver and with a rate cut?
So there's the Korean export story and there's the Korean domestic story. The export side, we had some more data overnight. The export side remains very strong, particularly semiconductors, and the semiconductor cycle might even be broadening out further. So there's bits of the Korean economy, particularly the external side, that despite tariffs continue to do really well. And from an equity investor perspective, that's actually quite exciting, given that the administration is also quite focused on boosting valuations. And then there's the domestic side of things, where inflation is very contained, demand's quite low. And also I like to sort of look out 10 to 20 years, and the worst demographics in the world are arguably in Korea, right? It's going to be hard to see a very inflationary environment in a country with a contracting labor supply and weak demand. So generally speaking, I'm biased to be overweight Korean rates and to expect continued dovish policy from the Bank of Korea. There's just one little factor, which is we do expect a decent fiscal impulse from the new Korean administration, which might stop the bonds rallying too much. But yeah, in general, I'd be looking to be long both Korean bonds and Korean equities, but for very different reasons.
Ian, great stuff. We'll leave it there. Thank you so very much. Ian Samson is multi-asset portfolio manager at Fidelity International, joining from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Bit of anxiety in markets today ahead of the speech from Fed Chair Jay Powell at the Jackson Hole Symposium. Stocks pulled back, bond yields rose. The outlook for rate cuts dimmed a bit with signs that inflationary pressures may be building. Walmart is seeing cost increasing each week, noting those costs will continue rising in the second half of the year. And the Philly Fed's price indexes rose further above their long-run averages, even though the overall level of manufacturing in the Philadelphia area contracted. Earlier today, we heard from Austan Goolsbee, the head of the Chicago Fed. He spoke with Bloomberg's Michael McKee in Jackson Hole and Michael Shepard in Washington.
We're talking about interest rates. What's going to happen September 17th?
Well, it depends. For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target, the economy's looking relatively solid, and that it made sense for rates to come down a fair bit more from where they are right now. In the interim, we've had mixed messages. We've had some inflation reports that came in milder than we expected, and I was feeling good because I thought if the tariffs kind of stay in their lane and imported goods are only 11% of the economy, there is a real sense in which maybe we never left the golden path. We threw a bunch of dirt in the air, as I described, so you couldn't see the road there for a bit, but maybe we're still on it and it'll be fine. The last inflation report that came in, where you saw services inflation, which is probably not driven by the tariffs, really start shooting up, is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
Well, a live meeting implies that you could perhaps cut interest rates. Are you leaning in that direction?
Look, as you know, I don't like tying our hands ahead of time.
But
I want to get all this information. It's particularly important given that we've been getting some mixed signals. And I want to hear what my colleagues have to say going into September or November, December, going into next year. The most important thing is to figure out the through line. And the through line is either we're still on path to get rates down a fair amount. You know, let's say the SEP dot plot, where they ask all the members of the FOMC, where do you think rates will settle eventually? That's 100 basis points plus below where we are now at the median. And what will determine whether we can get back on that path of rates coming down is going to be, do we think inflation is under control? We've been 4.5 years above the inflation target. I thought, and we made a lot of progress, and I thought coming into this year, we were in a decent spot that you could make the case we're headed back to 2%. I'm still hopeful that that's true, but I'm a little, as I say, in the last report, there are a couple of little warning signs, and how we are going to react to a stagflationary direction shock. That is something that is driving down employment and up prices at the same time. That's always a very difficult spot for the central bank.
President Goolsbee, I wanted to come back to the broader question of the economy and inflation, too, because earlier this month we saw tariffs start to actually take effect and be enforced. And we may have more coming still on drugs and semiconductors. Where do you see this impact playing out across the economy? And how soon do you expect to see businesses start to pass these costs along to consumers?
That's kind of the critical two questions about tariffs are how much are they going to drive up prices and how long is that price increase going to last? So there is an argument that in pure theory, if it was a one and done tariff, that'd be a one-time increase in the price level. And then as an inflationary impetus, it would be transitory. But as soon as you use the word transitory, you want to be a little careful. That's only for a one and done tariff. And this hasn't been one, and it doesn't seem like it's close to done. So we can get on a cycle that is inflationary. And if the tariffs are applying to intermediate goods, that is parts, components, supplies, things like primary metals, semiconductors, things that go into the cost of production for U.S. manufacturing, that is one way that tariffs jump out of their 11% of GDP lane and start making me more nervous, because now it ceases to just be an increase in the prices of the tariff affected goods. Now those tariffs are raising prices in the goods, the industries that are using the tariff affected goods. And we saw in COVID, the bigger that is, the more it's affecting the supply chain and disrupting it, the longer and more persistent that can last. So those are kind of the questions floating around that we're grappling with.
Austan, I want to go back to the White House versus Fed situation for a moment. The administration has alleged mortgage fraud against three people: Democratic Senator Adam Schiff, Democratic Attorney General of New York Letitia, and then now Lisa Cook. You were the chairman of the Economic Advisors Council to President Obama. You're a Democrat. Are you worried that they might come after you?
I didn't know where you were going with that. As I say, I'm here, member of the FOMC. The law is quite clear of what should determine interest rates. It's the FOMC, and we're supposed to be looking at stabilizing prices and maximizing employment. You become a sworn member of the Federal Reserve, you're out of the politics business. You're out of the elections business. So I'm trying not to get distracted from the basic thread of we must figure out where we are on those dual mandate grounds when setting the interest rates. And that is what we should be basing the interest rate decisions on. It shouldn't be about power politics. It shouldn't be about what somebody said about somebody else on Twitter. We go into that room and we take the job very seriously.
That is Austan Goolsbee, the head of the Chicago Fed, speaking with Bloomberg's Michael McKee and Michael Shepard right here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.